Joining me right now is Grant's Interest Rate Observer founder and editor, Jim Grant. It's great to see you, Jim.
Thank you, Maria. It's nice to be here.
Thank you so much for being here, and congratulations on 40 years of Grant's Interest Rate Observer. I was there at the beginning, not at 40 years ago, but maybe 30. So I'm happy to still talk to you all this time. What was your take on the Fed, and how do you see the interest rate moves going forward after 11 rate hikes and a pause yesterday?
Well, you know, it's possible that we are embarked on a very long period of high rates, high as defined in the context of zero. So they were down, rates fell persistently, not constantly, but persistently for 40 years, 1981 to 2022. Or
wow.
21, yeah, 40 years. It whizzed by. And so people naturally are kind of thinking, well, they'll revert. They will go back to levels that we have come to see as normal, but in fact have been quite abnormal. So I think that the important point in today's rate discussion is not so much what the Fed is going to do, but what it has done. 0% for more or less 10 years, approximately free money, you know, figuratively speaking, is a very important feature or fixture of our financial affairs. So whether we go to 5 or 5 1/4 or 4 7/8 on the Fed, that's important. But I think more important are the consequences of 10 years of approximately zero. So that lent everyone a sense of false confidence. They could raise money, they could start a business, they could do anything, buy a house, build an office building at very concessionary rates. So that has introduced an element of fragility throughout the economy. And the longer that today's higher rates soak in, the more people will come to terms with the new cost of debt.
Yeah. It's a great point, because over that 10-year period when they were talking about and having zero rates, people went out on the risk curve. They bought, risky stocks in some corners of the stock market. They bought crypto. They bought .com. So how does that change? I mean, you looking at a pivot here that we're going to see now rates higher for longer. What does that mean in terms of investing?
It means some good things and some not so good things. Among the good things is, for example, that people who save and you buy a bond and twice a year you get coupon income. Well, now you can reinvest that if I'm right about the prospects for the next several years, indeed several decades. You can reinvest that at higher rates rather than lower rates. And so that's the reinvestment income is going to be higher. That's good. And also good is the possibility of earning an actual living wage on your savings for a new saver. So, for example, current coupon mortgage-backed securities are offered at 6% or so, with no credit risk. That's much higher than Treasury bond yields. So these are things that are new on the menu of options for savers. That's good. Not so good is that higher rates are going to enforce a new sense of reality in the financial affairs of highly leveraged companies. Highly leveraged, highly speculative portfolios, for example, in college endowments. Difficulties in the federal budget. Congress has been used to borrowing at less than 2%. Now it's going to be rather more. Yeah. So it's interestingly, Maria, the Fed, some of the Fed's own measures of financial tension, the financial conditions indices, for example, the Chicago Fed register easy. They say that conditions are in fact easy. Conditions are difficult because of the companies that have borrowed too much at too low a rate and now are facing reality. Right,
and that's why we've seen a string of bankruptcies. I mean, that's a game changer. If you are counting on your interest payments being $2 million, and suddenly they're $14 million, which is a scenario Bob Nardelli shared with us.
Right.
You've got a problem, and that's why we're seeing in some corners a bankruptcy string of small and mid-cap companies. That's what I want to ask you. Have we seen the full impact of 11 rate hikes, and how slow does the economy become?
I'm not sure about the latter. I don't know when. Certainly, we will have a recession. That's obvious sometime. But I think that the longer these rates persist at current or near current levels, the more companies, individuals, governments will face the need to refinance at rates that will seem punitive, even though over the long sweep of time they are merely average. So you're seeing the kind of the meat reality show every single day in a different corner of the economy.
Yeah. So are you not buying into this idea that at some point the Federal Reserve has to cut rates again? Because we are going to see an impact from these 11 rate hikes. It is likely going to slow the economy down. We've been waiting for this, and it's not happening so far. Nancy Lazar over at Piper Sandler says, look, we're going to have a recession first half of the year. Would we see an economy slow to a recession-type environment that would trigger the Fed to cut rates?
Probably, yeah.
Probably.
Probably. The great unknown, of course, is whether the dollar, the world's reserve currency, the Coca-Cola of monetary brands, will stand up under a succession of rate cuts that are now customary in times of recession. But on form, if there's a recession in the first half of this year, next year, as Nancy says, the Fed will cut rates. And in that case, there'll be good times in the bond market.
So you still think higher for longer, but a cut next year at some point?
Well, I think that rates may persist on a steady to rising path, not constantly, but persistently, for many years, indeed, perhaps decades to come. That's the form, the historical form. But over the course of the great bond bear market of 1946 to 81, there are many times in which rates fell. Yields were rising for 35 years persistently, but not constantly. But over the course of those years, there were many intervening rallies in bond prices, meaning declines in interest rates. So if we look forward to, it's always going to be up and down, and it's never one trend constantly.
But still elevated than where we saw it in the last 10 years.
I think so.
Stay right there. We've got initial jobless claims out. We're going to see what these numbers are and see if there's a market reaction. Right to Cheryl, because when we go, Cheryl.
They actually rose week to week, Maria, and coming in a little bit hotter than expected on claims. 217,000. The estimate was 210,000 for initial. And then if you look at continuing claims, also hotter than expected, 1.818 million. The street was looking for just a clean 1.8 million. And again, they have risen from last week's numbers to now. So we'll see what this does with the October jobs report. That's out tomorrow. 180 jobs is and 1,000 jobs is the expectation. The rate 3.8% unchanged. Back to you.
All right. We got jobless claims at 217,000, as Cheryl just reported, Jim. And we got a jobs number tomorrow. Economic data is also a factor for the Fed. What are you expecting in terms of the jobs numbers, and where does this economy go going into the coming year, as the Fed says he's still looking at the inflation target of 2%?
Well, when the bottom falls out, there's no bell, there's no press release, it just falls. And I think there's a non-trivial chance that these rates will bite quietly, but in a kind of a deep cut to our economic expectations and to the labor market, which is now very, very strong. So whether that happens next week or next month or the first half of next year, I don't know. But I think that there's a lot of mischief in 0%. And that mischief is now, to me, the story of the cycle. When will these rates manifest in much higher joblessness and in much more intense and more frequent bankruptcy? That, to me, those are the questions.
Those are the questions, for sure. So are you, as a result of that, are you poised to stay in fixed income, stay in hard assets, raise exposure to gold? What do you do as an investor?
Well, it's sticking to interest rates. There are things to be done on both sides. For example, you can invest in floating rate securities that will give you a certain level of non-volatility. You can look for bonds that have been sawed in half in price, and that will have kind of an explosive rise to the upside if the Fed cuts rates. You can look at the aforementioned mortgage-backed securities that are yielding a lot more than treasuries, but without credit risk because they're essentially guaranteed by the feds.
Okay.
So there's a lot to be done in fixed income this year, whereas the preceding dozen years, it was kind of, what? Interest rates? Where are they?
Yeah, exactly. You had to go find.
And here they are.
Exactly.
And for some of us, it's very good news.
Jim, it's great to talk to
Thank you, Maria.
A legend on Wall Street, by the way. 40 years and counting.
Thank you.
Thank you so much. Good to see you. Jim Grant. We'll be right back.